So for you to have an investment property, you must hold it for three things. Number one, to earn rental, that's number one. For capital appreciation. Most of the time with capital appreciation, it's the land component where you keep it for capital appreciation. But to earn rentals, it will be both. It will be normally buildings where you're renting it out to tenants and commercial companies like your Pick and Pay and whatsoever. Right. So if you want to understand it much better, you must go to the paragraph, IS40 paragraph 5. This is where all this is there, where they explain everything. So it is very important for you guys to understand what is the investment property. The investment property is a land or a building. So here they are very specific. They are not talking about any vehicle or whatsoever. They are talking about, because sometimes you can rent out a vehicle to certain people. It doesn't qualify as an investment property. It will be falling under property, plant, and equipment. So in this case, they are very specific in the standard. They are talking about land and buildings. They are not. There is no any other asset that is mentioned here that you hold to earn rentals or for capital appreciation. It's very important to note that. Right. So if you hold a building or land for any of the following purposes, then it cannot be classified as investment property. So for example, if you hold a building for production or supply of goods and services, for example, let's say you have a factory. A factory cannot be investment property. If you hold a building for administrative purposes, I've made an example earlier where you have a building, but that building is where your employees are working, where you do all the administrative work for your business. That cannot be an investment property. So what does that mean? It falls under property, plant, and equipment. It doesn't fall under IS40, right? For sale in the ordinary course of business, what is this? Where you have, let's say, for land, or other than land, buildings, you're building property, and then you are holding it with an intention to sell. In that case, you cannot say you have an investment property. And which standard would it fall under in this case? For number 3, for sale in the ordinary course of business, it will be inventory. Because if you are building houses with an intention of selling it, in your books, you'll hold them as inventory, right? Or if you're buying land with an intention of selling it to the property developers, it will in your books it will fall under inventory as you have stock that you're selling. In this case, being your buildings, your land or where you're developing apartments to sell. So if you are using your building or land for first 2 purposes, meaning that for production or supply of goods and services or for administrative purposes, then you should apply IS16. And the standard of IS2 inventories fits when you use them for the sale in the ordinary course of business. So in that case, guys, you won't have a situation where you have investment property. So it's very important for you to note that. And guys, as I move to another topic here, just send me a hand or raise your hand if you have any questions that you want to ask, because I want us, before we move on, so that you get an understanding of what I'm explaining to you now. So now, at least we are clear what is exactly the investment property and then what is not investment property. Investment property, I've done the summary also for you. Investment property, if it's investment property, the answer is yes, then you must be earning rentals, or you must keep it for capital appreciation, in this case being land, or for both, right? But if it is not investment property, it means that you keep you keep the building for production of supply of goods and services, apply IS16, administrative also apply IS16, sale in the ordinary course of business, I'm saying apply IS2, which is inventories. So, and then under the, basically it's only investment property only if you're earning rentals or capital appreciation. And remember, it's land or buildings. It cannot be any other assets other than land. So I'll move on to examples of investment property. What specifically can be classified as an investment property? The following can be classified as investment property under IS 40, paragraph 8. Land held as an investment for long-term capital appreciation or for future undetermined use. Remember, if you keep the land for future undetermined use, you must have an intention still. I will make a typical example. We have a local municipality that is got land that it had kept for future undetermined use. It must still determine as to what is it keeping it for. Like, for example, if it's keeping it for capital appreciation, right? Or either if it's keeping it for development. Because the municipality can still have a vacant land, but the intention is to keep it to develop RDP houses. In that case, it cannot, that land, even if it's vacant, it cannot be classified as investment property because they're going to develop they're going to develop houses there. So they will convert that into residential properties and whatsoever. You don't know yet when you'll use it for. So the undetermined purpose, so you keep the land for undetermined purpose. However, if you buy a land and you intend to build some production hall, you see, here's another example. So however, if you buy a land and you intend to build some production hall for your own purposes sometime in the future, then this land is not an investment property. So you bought the land that is vacant, but your intention is to build, in the future, is to build a production hall. That land cannot be investment property. So it's very important for you guys to note that. A building owned by the entity or leased out under one or more operating leases, right? A building owned by an entity or leased out under one or more operating leases. This includes a building that is still vacant, but you plan to lease it out. So that you should know, that is another example. Any property that you actually construct or develop for future use as investment property. Also, be careful here again, because when you construct a building for some third party, this is not an investment property, but you should apply IS 11 construction contracts or IFRS with revenue from contracts with customers. So these are examples. Go through this paragraph IS 40, paragraph 8, where they've listed these examples. So also, when will you be in a situation that you will need to recognize investment property? So now, number one, guys, I'm taking you back. Number one, we know what is investment property. It's land or building that is kept for capital appreciation or alternatively to earn rentals, right? That you know, right? If you're keeping the land or building for production or supply of goods and services, administrative purpose, sale in the ordinary course of business, that is not investment property, right? So now, the question here is, when to recognize investment property? When will you be in a position to recognize an investment property? Remember what we've just dealt with above there is basically the definition of what is investment property. So if you get a question in the exam to say that, please advise as to whether the entity should recognize this land as an investment property, where do you start? First, you start with the definition. You state. Guys, I would advise you to actually take notes, because what I'm going through here, it can come in a theory format where, as I said, in the exam condition, you can get a question where it says, advise management whether they should recognize the building or the land as investment property. The way you're going to structure your answer, number one, you start with the definition. That's where you start. You go through IS 40, you state what is the definition of investment property, all those criteria. right? If those criteria are met, you don't end there. You must go another heading. So you have a definition, and then from the definition, you go to the recognition criteria. So this is where we are now. You put that also as a heading. You say recognition criteria. When to recognize investment property. Remember, I'm telling you this because it comes in a theory question. As I said, you start with the definition, then you come, you state the recognition criteria. So what does it say? It says the rules for recognition of investment property are essentially the same as stated in IS 16 for property, plant, and equipment. I.e., you recognize an investment property as an asset only if two conditions are met. What's the first condition? It is probable that future economic benefits associated with the item will flow to the entity. The second one, the cost of an item can be measured reliably. Right, let's start with the first question. First, remember now you're answering a question. You've written in your thing, recognition criteria. You state, what are the recognition criteria? You say, it is probable that future economic benefits associated with an item will flow to the entity. Last week, when I was with Solomon, I made an example. I said to Solomon, with PPE, what will make for you to say it's probable that future economic benefits are going to flow to an entity? And also, guys, you'll note that in the previous lecture, but I'll take that example and put it here. And again, I'm going to make another one for investment property. For you to determine that it is probable that future economic benefits associated with the item will flow to the entity. What are these future economic benefits that we are talking about? Because I see the standard refers to future economic benefits, but really, what are future economic benefits? I made an example last week with Solomon to say that we buy a plant. In that plant, we are going to produce milk, right? And we're going to sell the milk to the customers. In return, what we're gonna get? We're gonna get the revenue that will generate from selling the milk. So by future economic benefits, they are referring to the revenue in terms of selling the milk that you're going to get from customers because they're gonna pay you for that milk that you're selling to them. So basically, that's what they mean. Future economic benefits is in the form of revenue, right? So in this case, with property, with investment property, what are the future economic benefits? So number one, if you build a building and then with an intention of renting it out to tenants, both tenants, residential tenants, and also the commercial tenants. So in return, as a company, what are you gonna get? You're gonna get rentals, right? So these rentals, guys, are you still comfortable? There's no questions, right? Don't feel afraid to ask questions. I'll respond immediately. You can just type and send to me. So I'm saying to you, future economic benefits in this case will be in the form of rentals that you're gonna get. This is how you're gonna generate your revenue. Your revenue will be in the form of rentals that you're going to generate from basically renting out this investment property, being the building. So what will make you to be sure that it's probable that the future economic benefits are going to flow to the entity? So if, let's say, you have a building that you're renting out to the tenants and already you have a lease agreement that you have signed with your tenants, right? So that's the probability criteria, because you would have signed agreements with tenants. So I can conclude in the exam position, maybe you have that information somewhere where they tell you that already you have signed agreements or service level agreement with lease contracts with tenants that you are renting out the building. So I would say that yes, it is probable that future economic benefits in this case, because we have already signed lease agreements with tenants. So it is highly probable that we're definitely going to be getting rentals, because if they are not paying me, the rentals, I can sue them. You understand? Because you have an agreement you have signed. So the second part here is the cost of the item can be measured reliably. How can you measure the cost of investment in property reliable? Last week with Solomon, I made a typical example of that plant that we bought. If let's say you're paying it cash, where through they invoice you, definitely you can identify the cost of the plant through an invoice. But if we are building it, like we are constructing it from scratch, then what are those costs? How can you measure the cost reliably? You will see that when you construct a plant, there will be costs that you're going to incur in as far as labor is concerned, right? People who are building, they will submit timesheets, right? Who are constructing the building. So they are observable from the timesheet, the cost that you'll spend in terms of building the building. And then also what other costs that you can incur, the raw materials, right? Cement and all that. There will be invoices that you'll be getting it from suppliers for building that factory. So already you can measure the cost reliably because there is invoices. There is labor, meaning timesheets and the time they've spent, the rate per hour, right? What else that you can actually incur? The overheads. The overheads will be observable because the overheads will be, I don't know what costs that are related to overheads, but there will be invoices related to that as well for overheads, electricity, and all that to construct that factory. So in the exam position, guys, these things, that's what they mean. It's very important for you to write notes now because a lot of people, they see these recognition criteria, but they don't understand what they mean. When they say to you, the cost of an item can be measured reliably, if you're buying an asset or a building, definitely get an invoice, you'll sign an agreement, right? So already you can identify the cost because it's stated there, so you can measure it reliably because it's stated in the invoice and then it's stated on the agreement. And also with probability criterion, I've mentioned earlier to say that if you have signed a service level of agreement or lease contract with clients, already it is probable because you definitely sure that you will generate the future economic benefits. In this case, what is future economic benefits? The lease rentals in the form of revenue, right? So I can move on. I think you understand what do they mean by probability, and then what do they mean by you saying that you can measure the cost reliably. So how to measure investment property initially? So already what we have dealt with, we've dealt with the definition, right? We've dealt with what is the recognition criterion. So already picture yourself in the exam condition. So you've dealt with the definition because you need to conclude or advise management as to whether we should recognize this item of investment property or this item being land or building as investment property or not. So you're going through all this. Number one is the definition. Number two is the recognition criterion. You discuss all that. Then you discuss now how to measure investment property initially. And by the way, guys, let me take you back again. In as far as when they ask you whether is this an investment property, another thing that I forgot, the first thing you must start with is the definition of an asset. Before you even go to the what we call to the definition of investment property, discuss what is an asset, right? A resource controlled by an enterprise as a result of past event from which future economic benefits will flow to the entity. Then, based on that, you discuss a resource controlled by an enterprise. You state why is it as a resource controlled by an enterprise. From past event, you discuss the past event. Future economic benefits, you discuss. In this case, it will be rentals. Then you come, you discuss the definition of investment property. Guys, I'm actually encouraging you and I'm forcing you. What I'm discussing here, write it down. It doesn't have to be only investment property. Each and every item of PPE where we are asked to discuss whether it should be recognized as PPE or not. This is the structure you need to follow. First, the definition. Number two, you discuss the definition, and then you discuss the recognition criteria. Then you discuss what else? The measurement. So in this case here, what we're talking about the measurement. Now that we can recognize it, how are we going to measure it subsequently, initially and subsequently? So first of all, how to measure investment property initially. Investment property shall be measured at cost, including the transaction cost. The cost of investment property includes its purchase price. The purchase price in this case will be observable from the contract that you have signed to buy that building or to buy the land. But not only that, they will also invoice you. So already the purchase price is observable also from the invoice, right? Any directly attributable expenditure, such as legal fees or professional fees. Legal fees, remember guys, for title deeds now to the land, right? You're gonna pay lawyers to do that for you with the deed office. So the cost that you're gonna pay to the lawyers to do the title deeds, to transfer ownership of the land to you, those costs that you have incurred, you're gonna capitalize them as forming part of the investment property. Or professional fees, property taxes and all that, right? You're gonna capitalize all of that. The cost, however, does not include the following: startup expenses whatsoever. However, if the startup expenses are directly attributable to the item of property, plant, and equipment, then you can include them, but do not include any general startup expenses. Operating losses, for example, that you incur before plan occupancy level is achieved, and abnormal waste of material, labor, or other resources incurred at construction, right? You don't need those costs, you actually expense them. When a payment for investment property is deferred, then you need to discount it to its present value in order to set the cash price equivalent. I'll make a typical example. You buy a building, right? When you buy this building, in the contract, in the contract, it is specified as to how much it's gonna cost you. Let's say 2 million, but they say to you, you're gonna pay this 2 million over time, over the 2-year period. Meaning, for first year 1 million, second year 1 million. So what you must do when you recognize the investment property, right? The building, you must discount the present value, meaning the 2 million, because the 2 million is a future value. You must discount it to present value. Then you must capitalize the investment property, right? Then you must also recognize the liability, which you're going to amortize it over the 2-year period. So obviously, then that being the case, it means you'll have an investment property being your debit leg. Let's say you discount this 2 million, and then you get the present value of 1.2 million. So you must debit investment property 1.2 million, which is how much you're going to recognize. Then you're going to credit the liability 1.2 million. But remember, with the liability at year end, you must amortize it, meaning that you must recognize the interest that you're incurring, the time value of money, debit the interest every year, credit liability. So this liability will be amortized and it will grow. It will unwind up until it reaches 2 million at the end of the 2-year period. Then you settle, right? Obviously, if you're settling 1 million every year, and then it will reduce because it's going to reduce the liability you're owing, right? Also, the interest part will also reduce. And the interest part, remember, is going to go to the income statement, right? So that's what they mean here by deferring the payment, right? Any questions, guys? Are you still fine? Any questions? Just drop me a message. I will respond. I'll check your questions and respond. Subsequent. So basically, what I've spoke about here is initial measurement. You have the initial measurement. Initially, when you buy an asset, this investment property, how would you recognize in your books? So that's initial measurement. We have subsequent measurement of investment property, which is very important. So when you in your exam condition, when you get this as a theory, you must first discuss them under the measurement. There's 2 things you're going to discuss: the initial measurement, which is what we have gone through, but in addition, you're going to discuss the subsequent measurement of investment property, which is this part here. So after initial recognition, you have two choices for measuring your investment property. IS40 paragraph 30 tells you, basically lists what you need to follow. Once you make your choice, you should stick to it and measure all of your investment properties using the same model. There are actually exceptions from that rule. Right, now let's see under subsequent measurement. Subsequent measurement of investment property, you can measure investment property in two ways. Number one, you can measure it at fair value, right? So meaning that every year you're gonna fair value the investment property, right? And then the difference, meaning that let's say the investment property at year end, it was sitting in your books at 2 million. Then when you look at the fair value is 3 million. So the difference of 1 million, you're gonna recognize it to profit and loss, right? Not to revaluation whatsoever. That's the difference between the revaluation and the fair value model under investment property. So if your investment property here and the carrying amount was 2 million, then you look at the fair value when you have to measure it at fair value, it's 3 million. The 1 million, you're gonna recognize it in the income statement. How do you recognize it? You debit investment property 1 million to increase the cost from 2 million to 3 million. Then you're gonna credit the fair value adjustment in brackets you put income statement, right? Then there will be tax consequences. We'll discuss that, right? So these will be your journal, and I hope you're writing this journal down. Journal down as an example. So you debit investment property, being your actual investment property of 1 million. Then you credit fair value adjustment in brackets. You must put the income statement because it's not OCI. Revaluation model let me see. Yeah, with fair value changes taken to statement of comprehensive income, profit and loss. Exactly what I've explained. That's another model, right? Now, if you're carrying it at cost model, right, there's gonna be depreciation. If you're carrying it at cost model. So it's similar to property, plant and equipment. There's no difference. So basically what you're gonna have is the cost of 2 million, which is not gonna change. The only thing you're gonna do, you're gonna apply depreciation every year. If it's the straight line method or a diminishing balance method or whatsoever, you're gonna apply the depreciation. Then you're gonna have the accumulated impairment loss. If there's any impairment at the end, then you're gonna come up with the current amount. So that's the treatment, right? So there's two models. So basically, these should you change your model, it will result in change in accounting policy. Then you know when you have a change in accounting policy, you retrospectively adjust, meaning that you go back to priors, you adjust also prior. But we're still going to go through that standard IS8 for changes in accounting policies, estimates, and all of that. So now, I've taken you guys through the two models. So initially, we discussed the what we call, let me just see, we've discussed what is an investment property in terms of the definition. We have gone through the recognition criteria, right? Now, we have also discussed the measurement, meaning that initially, how do you measure it, and subsequently. I'm begging you guys, just write down some notes of what I'm telling you, because when you go through the notes, it will help you as well. You'll develop a skeleton of what you need to know under investment property statement. So you must know what is investment property, number one, the definition, and then you must know the recognition criteria, right? And then you must know the measurement. The measurement are in twofold. Number one, initially when you measure it, and then subsequently when you measure it. Subsequently when you measure it, it means that you must know whether it's a fair value model or it's a revaluation, it's a cost model. So those are the two things under subsequent measurement that you need to know. If it's a cost model, you must know you must provide for depreciation. If it's a fair value model, there is no depreciation at all. The changes in fair value are recognized directly to income statement, right? Fair value model, I'm taking you through the fair value model now, the notes. Under the fair value model, an investment property is carried at fair value at the reporting date. The fair value is determined in line with the standard IS18 fair value measurement. You know that standard for fair value measurement, right? A gain or loss from remeasurement to fair value shall be recognized in profit and loss. That's what you must know under fair value model. You don't recognize a change in fair value in OCI, right, guys? It's important. You recognize it to profit and loss. Every changes that are happening to fair value every year, they must go to profit and loss, not to revaluation. Sometimes the fair value cannot be reliably measured after initial recognition. This can happen absolutely rare circumstance. Active market cease to exist. Sorry, Apple here. Active market cease to exist, and in this case, IS 40 prescribed. This is prescribed under IS 40 paragraph 53. To measure your investment property at cost, if it's not yet completed and is under construction, to measure your investment property using cost model if it's completed, right? So now the cost model is not different to property, plant, and equipment. It's the same thing. It's not different. The second choice for subsequent measurement of investment property is a cost model. The cost model, here, IS 40 does not describe it in detail, but refer to the standard IS 16 property, plant, and equipment that we had discussed last week. It means you need to take the same methodology as in IS 16, meaning that you'll have the initial cost, the subsequent measurement, it will be the depreciation, right? And then, or the revaluation, it will be up to management, right? And then, yeah, you'll have the useful life and all of that, right? So also, so we have discussed the subsequent measurement, meaning the cost model and the fair value model. So now, what we need to discuss is the switching of the models. Can you actually switch from cost model to fair value model, or vice versa, from fair value model to cost model? The answer is yes, but only if the change results in the financial statement providing better, more reliable information about company's financial position, results, and other events. What does it mean in practice? Switching from cost model to a fair value model will probably mean meet the condition, and therefore you can do it whenever you are sure that you'll be able to determine the fair value regularly, and the fair value model fits better. However, the opposite change, switch from the fair value model to the cost model, is highly unlikely to result in more reliable presentation. Therefore, you should not really do it, or if really, for good reasons, right? So transfer from and to investment property. When we speak about transfers related to investment property, we mean the change of classification. For example, you classify a building previously held as property, plant, and equipment under IS 16 to investment property under IS 40. The transfers are possible, but only when there is a change in use or asset purpose. For example, you refer to IS 40, paragraph 57. You start renting out the property that you previously used as your headquarters, right? So now there is a change in intention, because what happened, you used to use this property for administrative purpose. Now you are changing your intention, you're gonna renting it out. Transfer to investment property from owner-occupied property under IS 16, right? You stop renting it. So in that case, when you start using it for yourself, you've changed your intention from the investment property to an owner-occupied, right? You held a land for under a purpose, and recently you decided to construct an apartment house to sell apartments when they are built, right? What's the accounting treatment in this? It depends on the type of transfer and the accounting choice for your investment property. If you opted to account for your investment property as a cost model, there is no problem with the transfers. You simply continue with what you did. However, if you picked up a fair value model, then it's a bit more complicated. When you transfer to investment property, then the deemed cost. When you transfer to investment property, remember you are moving from the property, plant and equipment, where you are depreciating this property, to investment property. The deemed cost, meaning that the cost you're going to initially recognize as investment property is a fair value at the date of transfer, right? So now, let's say you have a property that you used to recognize under property, plant and equipment, where you're providing depreciation. And at year end, the carrying value for that property, plant and equipment is 2 million. Now you change your intention, you want to use it as investment property, right? And then the fair value at year end of the same building, it's 3 million. So now you've changed the intention because you're renting it out, and your model that you're going to apply is fair value model. So they are saying the difference between the asset carrying amount, which is 2 million, and its fair value is, in this case, being 3 million, is treated in the same way as a revaluation under IAS 16. So what you'll do, you'll basically recognize the additional 1 million under investment property. First, you'll de-recognize the old building, and then you'll recognize the new one as investment property, right? And then you will also up the 2 million to 3 million by debiting investment property, crediting revaluation surplus, because you are initially recognizing the investment property. So in this case, that's the only case where you will never recognize it through profit and loss, because you have changed your intention from owner occupied to investment property. So when you recognize it in your books, you need to recognize this additional 1 million. So that 1 million will go through to the revaluation surplus, OCI. It's not going to go to profit and loss initially. But now the following year, when you fair value measure it, it will go to profit and loss. You understand that, guys? Ne? You follow? Ne? If you don't follow, just ask a question again, I'll clarify. When you transfer from investment property, then the deemed cost is also the fair value at the date of transfer. So meaning you are moving from investment property to owner-occupied property. Your deemed cost, the cost that you're going to recognize for the owner-occupied property, will be the fair value of 3 million. So subsequently, you'll depreciate if you apply the cost model. Or if you apply the revaluation model, then you revalue, right? So the change in intention for me is basically very simple. I don't think it's complex. So the derecognition, so what we have discussed now, we have discussed the transfers. Now, we're discussing when now you derecognize the investment property, right? The derecognition of an investment property, you're derecognizing the investment property. The derecognition rules, when you can remove your investment property from your books in IAS 40, are similar to the rules in IAS 16. You can derecognize investment property in two circumstances. Under IAS 40, under IAS 40, paragraph 66. You can either derecognize it when you dispose of it, or when the investment property is permanently withdrawn from use and no future economic benefits are expected. You need to calculate gain or loss on disposal as a difference between the net disposal proceeds, meaning that the proceeds that you're going to, you'll see when you do the example where you have, that example, no, not a good one, but the net disposal proceeds is basically the proceeds that you're gonna get minus the cost that you might incur related to that proceeds. So the net disposal proceeds minus the net assets carrying amount, right? Gain or loss on disposal is recognized in profit and loss, right? So it follows it's a trial and trailer method where whatever that you've been recognizing as fair value measurement going to profit and loss, it will follow also with your profit on sale of the investment property. It will go through profit and loss as well. So what I've done here is just a summary of what I've been discussing above. The derecognition for investment property. If it's a disposal, then you recognize a gain. When you permanently withdrawn from use, it will be a gain, definitely, because now you're going to get rid, I mean, it will be a loss because you'll derecognize the carrying amount, right, from your books. So you recognize that the gain and loss in profit and loss, the net profits proceeds. So basically, yeah, this is the formula. You take the net profit proceeds, you minus the carrying amount. IS40 investment property prescribe a lot of disclosures to be presented in the financial statements, including the description of selected model, how the fair value was derived, when the classification criteria for investment property are movements in investment property during a reporting period. Please refer to IS40 paragraph 74 and following for more information. So for disclosure, guys, I'll encourage you to actually go through the standard. In fact, for the whole standard, you must go through the whole standard. What I've just done here is just a summary note for you to be able to understand, because in the lecture room, we always have limited time. So this is it, guys. This is just investment property. For me, I don't think it's complex. It's very simple. But I want to just do a recap just a bit so that you understand what we're talking about. So what we have discussed, we have gone through what is an investment property, where we went through the definition, and I indicated to you that investment property is land or building. You cannot have an item of property, plant, and equipment any other than land and building. It's land or a building. It cannot be a vehicle. It cannot be any other asset other than land and building, right? It's land and building, right? That is kept for capital appreciation or to earn rentals. And then we have also discussed how should you account for investment property initially and subsequently, right? But before that, we also discussed the criterion, probability criterion, and then I took you through the examples as to what you do. I mean, how would you make sure that it's probable that the investment property will generate future economic benefits, and how can you measure the cost reliably? And then we also gone through how you should account for it initially and subsequently. Initially, the cost, you need to know whether the cost of the investment property, the initial cost that you pay for the building, and then or for the land, the cost that you incur, that you pay the lawyers to do the title deeds and all that, you capitalize. And then we've also discussed the professional fees that you pay, that will also capitalize initially. And then subsequently, we've discussed two models. The first model was the fair value model. When you apply the fair value models, whatever that change, the changes from the carrying amount to the fair value, it goes through income statement. Don't make that mistake and recognize it in OCI, right? That's another thing we've discussed. We also discussed, you also learn that the fair value model is not the same as the revaluation model. So for me, that is it, guys. And then I've discussed with you as to how you should go about in answering a question for investment property. Number one, you go through the definition of an asset. You move on from the definition of an asset, you go through to the definition of an investment property, right? Then from the definition, when I'm saying you go through the definition of an asset, you define to the lecture what is an asset, because at the end of the day, investment property is an asset. So you go through the definition of an asset. An asset is a resource controlled by an entity. In this case, if we would have bought it, we would have bought this investment property, it would have been the resource controlled by us, because all the documents are leading to us controlling it, and then you can control the risk, the way it is used, and everything. So we controlling it. As a result of past event, the past event would have been the decision made by management to buy the investment property, and there would have been a need to buy an investment property because we want to generate revenue in terms of rentals, right? And then resource controlled by an entity as a past event from which future economic benefits are going to flow. In this case, will indicate, even though you haven't yet concluded to say it's an investment property, but you can say, based on the scenario that you are seeing, you can generate rentals which are going to be in the form of future economic benefits, because they will result in revenue being generated. So you move on to the definition of an investment property. You state there to say that what is an investment property? In terms of IS40, an investment property is defined as a building or a land that is earned for capital appreciation or for to earn rentals. So you indicate based on the scenario you apply. You don't just define the definition of investment property. You apply it in the scenario. You indicate that you bought this building, and based on the information that you have, it is indicated that you're going to be earning rentals on it. And then, or if it's land, you go, like, for example, it will be held for capital appreciation. So you move on. Then once we have discussed that, then you move on to discuss the measurement. The measurement in this case, what you're gonna go through there would be, and then you can also argue and say that under investment property, you cannot recognize the following: production or for supply of goods, because those are not investment property. They should be recognized under I-16. Then you go and you further go and discuss what is measurement. The measurement, you discuss first you discuss the measurement in terms of initially how is it measured, the investment property, and then you also discuss the subsequent measurement that you can only apply to models: fair value model, cost model. Then you apply, they will give you information, you apply why you have to go out. You'll probably apply the fair value model because it is a market for this product, for this building, where you can source the fair value, right? If there is no market, you can always apply the cost model, right? And then you discuss what is fair value model, you discuss what is the cost model, and then you discuss, you don't have to discuss the switching the models, because in this case, the question was very specific to say that you must conclude whether this is an investment property or not. And then once you have discussed all of that, you conclude based on what you have discussed. Then this is how you're gonna get all your marks, right? I think from my side, guys, that is it with the lecture for investment property, unless you guys have got any questions. And I hope I've clarified it for you. It's gonna be easy when you start studying now to understand what exactly we're talking about when we're talking about the investment property. Any questions? Any questions before we move on to the examples that I promised that we were gonna do? Do you guys have any questions, or can I move on? You can comment, guys. Do you have any questions?
Yes, leadership.
Yes.
Yes. I wanted to. Can you give us an example in terms of abnormal credit terms, like if payments for investment property is deferred, its cost is at the cash price, so it's the present value of future cash flows. Can you give us an example?
I'll simplify it for you, ne?
Okay.
You buy a building, right?
Yeah.
You buy a building, but when you buy that building, you've negotiated with the person who's buying, who's selling the building, to say that because you don't have any funds for now, you can only pay him, like a typical example that I did last time, to say that you can only pay him over time. Let's say every year you can be able to pay him $1 million, right? This building is for 2 million, right? Initially, when you buy it, it's for 2 million. So meaning that the cost is observable from the contract that you had signed, or the service level agreement that you had signed with the seller. So you can see the cost there is 2 million. But the problem is that due to the time value of money, you can't pay the 2 million now because you don't have money. But after a year, you can pay $1 million, and then the following year, you can pay another 1 million, right? So maybe I should make it through an example, ne? So
yes,
let's make an example. So initially, the cost is $1 million, right? Sorry, it's 2 million. So this 2 million is observable from the service level agreement that we had signed, right? And then that part will also invoice you, right, for the building that he had sold to you, right? So it's observable also from the invoice, right? So now, initially, what are the journals that I'm going to pass? Let me do this. So this is what you're gonna have, right? So now, initially, I need to recognize this building that I bought, right? So I'm gonna have a building, right? And I'm going to have what you call, I'm going to have a building, and I'm going to have actually I call it a payable or a liability, right? This payable is amortized because due to the time value of money. I cannot recognize this. Let's say I'm gonna pay it over the 2 million or this 2 million over 2 years. Ne? So that will be 24 months. You agree with me? Because it's 12 times 2. Ne? Then let's just roughly say the interest is the time value. I mean the interest due to the time value of money is 10%, right? So that's your I. The future value is 0. I mean, sorry, the future value is going to be, because for now we don't have a present value. So over, or to simplify it for you so that I don't complicate, let's say we'll pay the 2 million after 2 years. Ne? You understand? We're going to pay the 2 million after 2 years. Are you with me, Solomon?
Yes.
Can you,
Yes, I am with you.
Right. So the future value, so this is basically the same as the cost, but now we need to determine what is the present value. Ne? Remember also here, we need to convert this 10% to monthly because it's 24 months. So divide that by 12. Ne?
Okay.
So that's 1%. And then now we want the present value because this is what you're going to recognize as investment property, right? So now let's calculate how much it's gonna be. PV. So now we have the rate, which is that, and then we have the number of periods, which is that. We have the payment. In this case, the payment will be, let's say the payment, let's just say the payment is 0 because we're going to make it the payment after 2 years, right? So after 2 years, we'll know exactly how much we're going to pay. Then over the period of 2 years, sorry. Then the future value, that's the future value. And then, yeah, let's see. So you see how much is the present value? 1.6 million, ne?
Yes, yes.
So that's what I mean. This 1.6 million is what you're going to recognize here as a building, ne? And then you're going to recognize the liability, right? Because while you're recognizing a liability, you're still owing. So this year is going to be your cost of your building as investment property, right? Initially, when you recognize it, right? But subsequently, also maybe let me put the fair value here. Ne? Let's say after year 1, ne, the fair value of this building is sitting at 2 million. I make it, let me make it at 2 million. Ne? This fair value or 2.5, so that because I have a lot of. So at year end, initially when you recognize at the beginning of the year, these are the journals you're gonna pass. Ne? But after 1 year, I mean after at year end, you must have finance cost, right? How are you gonna calculate your finance cost? You're gonna take finance cost, but now remember your liability must go up, right? You're gonna recognize, you're gonna amortize your liability. So how much is going to be your interest? Interest is going to be 1.6 million multiplied by that, multiplied by 10 by 12, because we've converted it to a month, right? This is going to be your interest, né? And then it's gonna go to your liability. Sorry, this is going to go to your liability, right? So this is how you're gonna amortize it. In the first year, there is no payment, so you're not gonna make any payment, right? But in addition to what you have just done, so remember now your liability has gone up to 1.8 million. You see, because after 2 years now, it will come back to that 2 million. But in addition, you need to recognize the fair value adjustment, investment property, right? Because now the fair value of this investment property has gone up. So you're gonna take the carrying amount, that, right? But let me make this positive. So now we need to recognize, because the fair value of this property has gone up, ne? So that minus that. So now we have a fair value adjustment of 886, right? But where is the credit leg gonna go? Fair value adjustment. It will go to income statement, ne? But under it's gonna be your income. So it's not OCI, it's income statement. As what? As revenue or income, right? So these are the journals that you're going to pass at the end. So the investment property would have gone from here to 2.5 million, you see. So this is what you're going to see under your balance sheet. Under your balance sheet, you're going to see a liability of 1.8 million. But not only that, you're going to see under income statement, the fair value adjustment of 861 million. But in addition, what you're going to see an investment property of 2.5 million. You see. Similarly, the following year, you're going to do the same thing. Did I clarify it for you, Solomon?
Yes, you did. Thank you very much.
Yeah. So this is just a simple example, but in your exam scenario, they will give you all the information. So what you need to know is that you need to discount to present value, recognize the investment property at the present value, recognize the liability, and amortize it over the years. Then this finance cost will go to income statement as well. So this is what they meant there when you defer the payment. So basically, I'm going to read this scenario, and then I'm going to take out. That's why I'm saying you must keep the scenario with you there. I'm going to take it out and then go and present the solutions, because I've done my own solutions. Ne? I see the lecture, I've done the example, but I've just presented it in a format that you can understand. Ne? So we're going to go through this example, and then we're going to go straight to the solutions, and then I'll take you through what is happening. So they are saying Technic Ltd is a manufacturing company. You need to highlight that, because also when you get the allowances, if you're a manufacturing company, there's a chance that for machinery and all that, you might get the 40, 20, 20, right, over the 4-year period, right? So Technic Limited is a manufacturing company situated in the Northwest Province, right? The company has a 30 June year end. Highlight that as well, guys. It's very important, because you need to know what's your year end. The reason why I'm taking you through this and explaining is because in the exam position, you need to know what are the keywords that you need to use, because you're going to read the scenario, but you'll need to refer back to the scenario. So if you didn't highlight, it becomes difficult for you, and that's where you waste a lot of time. So highlight keywords like year end, right? And then like maybe if it's a manufacturing company or it's just a retail company, you know. So it's very important, because there's a reason why they're saying it's a manufacturing company. In terms of allowances, SARS will give you different allowances as compared to if you are in a retail sector, right? Right. The following details are available regarding the assets of Technic Limited, right? The Technic Limited owns a stand, right? 326 Stanton, where the company carries out its manufacturing activities. The property was originally purchased, right? Here's the date, right? It was originally purchased. You highlight that, because you're gonna need it when you have to calculate depreciation now. Was originally purchased on the 1st of March 2015. What's our year end yet? They said 30 June, but you need to know 30 June when. Is it 2016, 2017? Right? So was originally purchased on the 1st of March for, this is the total cost of the property. But this property, remember, it's got land and then it's got building, right? Remember, the accounting treatment for both of these will be different. So hence they've separated it for you. You highlight. So in this property, you have two things. You have the land, and then you also have the building. For the building, the chances are that I'm thinking you're going to depreciate it, but for the land, you're not. Because for the land, you're carrying it at basically your intention is not use, is to sell. So the taxes will also change. So highlight that the property was available for use, right? Guys, the key thing here, available for use. For accounting, you depreciate an item of property, plant, and equipment when it's available for use. Can you just write that down? Even if you know it, just write it down. The property was available for use. When it's available for use, it means that's when you start depreciating, as intended by management on acquisition date, meaning that it was available for use on the 1st of March 2015 and was brought into use. This is a keyword also. Remember, for accounting, you depreciate when an asset is available for use. For tax, you depreciate when an asset is brought into use, not when it's available for use. So write that down. For accounting, available for use, you start depreciating. For tax, when the item of property, plant, and equipment is brought into use. Luckily here, the dates were the same. If the dates were not the same, let's say this property was brought into use the following year, you are not going to provide for any allowances for that year. You are going to provide the allowances when it is brought into use in that date, right? And remember, for tax purposes, you don't apportion, right? You don't apportion. Once you provide the depreciation, you provide the depreciation. But for accounting, you apportion. So also that is important. So the two things I want to take you to take here. For accounting, available for use, you start depreciating. For tax, brought into use, you start depreciating. On acquisition date, which is this date, 1st of March, a residual value, we have a residual value here. So highlight that, because this residual value you're going to use to calculate the depreciable amount, right? Was allocated to the building. And remember, this only applies to the building. You don't have for the land. So your cost for the building, which is 1.8, when you calculate depreciation, you must first subtract this 557 to get the depreciable amount. Then from there, that's when you can calculate depreciation. Was allocated to a building, and then also highlight for me the useful life, because it's very important. These things you're gonna use them, right? Useful life of the building was estimated to be 25 years. Do you see any useful life for the land? No, because you're not depreciating the land.
It's not depreciated.
The land cannot be depreciated. That's one thing you must know, right? Let's move on, right? I always like to make this example, guys. I know we have different beliefs. Some might be Christian or whatever. I'm not trying to offend anyone. We all believe in God. What I always say to my students is that if you look at the balance sheet, for example, right, all the assets are depreciated, right, except for one asset, which is land. And the way God is so wonderful is that whatever that he had created, you cannot actually depreciate it. So it symbolizes how powerful is God, because everything that he had created, you cannot demolish or do anything to it. So the land will always be there. But anything that is created by human, being your vehicles, your equipment, it will always have an end useful life. It will end. So the land, you don't depreciate. On 30 June 2017, the fair value of the land was determined to be 1.5 million, right? So now you see what is happening here. Initially, the land was 1.4 million. Now it has gone up to 1.5 million, right? Guys, remember, don't confuse this with investment property, right? This is not investment property. We are in IS 16, property, plant, and equipment. And what does this tell you? It tells you that this land, we're carrying it at revaluation model, right? We are not carrying it at cost, because already when they start giving you values for the land, it means that it might be revalued at the end, right? And when is this? Look at the date, 30 June. This is our year end. So now, initially when we bought this property, it was 2015. So already, I would say 2.5 years has passed, if I'm not mistaken. Sorry, yeah, it's actually 1.5 years passed, so almost, since we had this property. So highlight that information is very important. So it means that for every calculation we're going to be doing, it's going to be 2017, right? At year end, on the 30 June 2017, the residual value and estimated useful life of the building remain unchanged, right? Right. So there was no change between this. And remember, if there's a change in residual value, that's a change in estimate. right? And the change in estimate is prospectively adjusted, not retrospectively adjusted. What do I mean, guys? I mean, if let's say this 570 had changed from 570 to say 600, you were going to calculate the depreciation before the change, the 570, and then you were going to calculate the depreciation after 600. Then the difference, you were going to take that as a change in estimate in the current period. You don't go and adjust priors. I know we haven't yet arrived in that standard. You'll see when you arrive in that standard that we're going to be dealing with those things. But I'm just highlighting them for you here so that you're always awake as to what is happening. Because even last week when I discussed in that lecture, I've taken Solomon through the change in estimate. I mean, the change in useful life and the residual value. I said to him they were changing estimate. At year end, on the 30 June, the residual value and the estimated useful life of the building remain unchanged. No decision has been taken by the company to sell this property, right? Right, now we have discussed the land and building that was purchased, right? Now we're discussing the machinery. On 1 September 2016, highlight this as well, right? This is the purchase date, I'm guessing. On the 1st of September 2016, Technic Limited purchased a new, this is a new machine. What does that tell you? Remember, we are in a manufacturing environment. If you are purchasing a new machine, SARS will give you deductions in terms of section 12C, if I remember, where it gives you 40, 20, 20, 20, right? So this new thing, it must tell you something, that the chances that SARS will give you, because we are using this machinery for manufacturing, it will give you the deduction in terms of 40, 20, 20. So keep that in mind. So on the 1st of September 2016, Technic Limited purchased a new machine from a British company for 1.6 million. So this is the cost. This is the cost of this new machine. Let me just highlight it again. The installation and pre-production test. So now we have installation here, right? What should you know in your mind? These might be forming part of the cost. Not only for accounting, but also for tax, the base cost. The installation and pre-production test run were successfully concluded on the 30th of September. Okay, guys, let me highlight something to you here that you might have missed. We have a purchase date, right, which is the 1st of September. Then we have when this installation cost were successfully concluded. When was it? 30 September. Anyone? Any takers? What does this mean? I don't like pointing fingers, but let me. Solomon, what does that mean?
In terms of the installation pre-production test run.
No, not
in terms of or in terms of the whole scenario.
No. But due to the time, let me make it simple for you. You remember we've discussed earlier that we have available for use, we have the brought into use. What does this mean? Yeah, so in terms of that, that's what I mean. What does it mean? Okay, let me read it for you again. On the 1st of September 2016, Technic Limited purchased a new machine from British companies for 1.6 million, right? The installation and pre-production test run were successfully concluded on the 30th of September. You see, you have different dates here.
Yes, we have different.
What does that tell you?
Well, I don't know how to explain it, but okay, let me just try and give it a shot.
Yeah.
Okay, can I just explain in my own way? Yeah, so we purchased the machine in the 1st of September, right? And then we did the installations that concluded on the 30th of September. Right. So it means that we're going to have to add the installation to the purchased price.
Yeah, that's correct, but it's not what I'm looking for. Okay, for the sake of time, let me explain for you. Yeah, for the sake of time, what does this mean, Solomon? It means that this asset, this machinery, they are available for use date is not 1st of September.
Yes, it's just the purchase price.
Yes. No. I'm saying they're available for use date Remember, the available for use date is the date when you're going to start depreciating an asset. So
Yes,
a lot of
yes.
students will make a mistake. They will start depreciating on the 1st of September, which is wrong.
Oh,
So you must look at, because that's what property, plant, and equipment standard says. It says an asset must be depreciated on the date when it's available for use, right? In this case, in this example, they are basically telling you indirectly that the available for use date is not the 1st of September, it's the 30th of September. You understand? Because you
yes,
bought
yes,
it,
yes.
there, but when you bought it at 1.6 million, it was not available for use. Why? Because you had to do some installation and pre-production test. So when was that successfully concluded? On the 30th of September. And then that's when it was available for use. That's what I'm trying to explain, right? So you the pre-production installation and pre-production test, it cost us 35,000. Ne? So the samples produced in the pre-production test run were sold for 8,000. So you see, they've given you another item here that you need to take into account when you calculate the cost and also the depreciation. So you have 8,000 that you have incurred to sell the samples that you have produced in the pre-production, right? And invoiced by Technicon on the 30th of September, right? On the 1st of October, the machine was available for use. The 1st of October and the 30th of September is the same thing for me, right? The only difference is just a day, right? It's the same thing. So the available for use date they are telling you is the 1st of September, 1st of October, which is the same as 30th of September anyway, you see? So at least here they told you the available for use date, right? As intended by management, it was also brought into use, right? Brought into use. They are telling this information intentionally, brought into use on the same date, which is for tax purposes now when you have to calculate the deductions, right? So it was brought into use on the same 1st of October. The machine has estimated useful life of 5 years. Highlight that. A residual value of nil, so this one doesn't have a residual value, right? Was allocated to the machine. Additional information. The following is an extract from the accounting policies of Technique Ltd. During the current financial year, the directors of Technique Limited decided to revalue its owner-occupied land for the first time. You remember what I said earlier when they gave you that 1.5 million? I said the chances are that you'll do the revaluation. So the land you are revaluing, the accounting policy regarding owner-occupied land was therefore changed from the cost model to the revaluation model. So now we are revaluing the land. It is a company policy that the revaluation will be made with sufficient regulatory to ensure that the carrying amounts do not differ materially from that which would be determined using the fair value at the end of the reporting period. Owner-occupied buildings and machinery are accounted for using the cost model. So you remember we've discussed that last week in that lecture. Ne? What is a cost model? Because the cost model, you're going to have the cost minus the depreciation minus the impairment, right? You remember, ne? Depreciation on buildings and machinery is written off in accordance with the straight line method over the assets estimated useful life, right? So we are using the straight line method. Highlight that because that you need to disclose it in your notes, right? And the model that you are using. So the fair value of the land was determined by an independent sworn appraiser. This information is important because you also need to disclose this, ne? In your notes, right? And you also need to state the name of the appraiser. In this case, anyway, they didn't tell you who's the name of the appraiser, but you disclose this information for the user. The values were determined with reference to the current market prices on similar land in the same location and the condition. The South African Revenue Service allows the following capital allowances, right? For a building, they give it 5%. Highlight that. It's important because you're gonna need it for the deduction, right? And then, and also you apply the straight line method, not apportion. So they apply the straight line method, but they don't apportion. So you must remember, this is not accounting, this is tax. You just apply it straight. Even if you bought it during the year, you don't do any apportionment. A tax allowance on the machinery is 12C, right? And 12C of the Income Tax Act allowing a 40%. You remember what I said, because this was a new machine that you bought, the chances are that size will give you a 40% 20, right? Deduction in the first, and you are using it for production purpose. In the first year in which the machinery is brought into use, and then after 20% deduction, right, for the subsequent period. I'll add that as well, because you're going to need that information. Installation cost and revenue out of the pre-production test run of the machinery will be regarded as a capital in nature for taxation purposes, right? If I may ask, Rita,
Yeah.
What does this mean? When they say installation cost and revenue, right? Installation cost and revenue, you remember the one for 8,000, eh? What does this mean? When they say the installation cost and revenue out of the pre-production test run of the machinery will be regarded as of a capital nature for taxation purposes, right? What does this
mean? Okay, I'm not too sure, but I think is that you have to add it. You have to add it onto the cost before
no, you are right, ne? You are not adding it though, because remember, the is sales, so you must subtract it. You see, from the cost.
Oh, you subtract from the cost.
Yes, because it's sales. Remember, you're selling it, right? So you must subtract it from the cost, right?
Okay.
Yeah. So what does that mean? It boils back to the example that I did for Solomon last week, to say that the carrying amount of an asset is actually revenue indirectly, because if you read the definition of an asset, it says it's the resource controlled by an entity and as a result of past event from which future economic benefits will flow. And I asked last week Solomon to say, what are these future economic benefits? I made an example of a milk where you're selling milk. Ne? So if you're selling using the same plant that you bought for 1 million, that 1 million that you see, the cost that you've incurred to buy this plant, is equivalent to revenue that you're going to generate for 5 years if you are depreciating that plant for 5 years. So it is estimated that for the 5-year period, you're going to generate revenue of 1 million. That's what it means. So by future economic benefits, they mean that 1 million that you bought for the plant, for the 5-year period, you're going to generate revenue worth 1 million. So in this case, this revenue where we sold the plant, the reason why we are deducting it from the plant, from this cost, is because already you have generated that revenue of 8 million, you see? So now you must take it out so that you are left with the revenue that you still need to generate, you see? But if you're not sure, go through the lecture that I have done last week, and then if you're still not sure, next week, I'll take you through another example so that I clarify it for you. What do I mean when I say each and every asset, the cost of it actually represents the equivalent of revenue you will generate during the period in which you are using it, right? The South African normal corporate tax rate is 28%. The capital gains tax inclusion rate is 8%. So this information, you highlight it in the exam, because this is the information you're going to use. If you start using 27%, you're going to be wrong, because they gave you here the tax rate of 28%. The inclusion rate is 8%. Highlight that, right? Deferred tax is provided for on all temporary differences in accordance with the statement of financial position approach. There are no other items causing temporary or exempt differences except those identified in the question. The company will have sufficient taxable profits in the future against which any unused tax losses can be utilized. Assume that land and buildings are regarded as separate classes, right, of assets. So you're going to treat them separately. Assume that all amounts are material, right? Now the question here says, the required says, disclose the following notes to the financial statements of Technique Limited for the year ended 30 June. Property, plant and equipment, total column is not required. They just want the property, plant and equipment. So in this case, they want you to disclose the notes. The notes, what does the notes include? It includes the notes for property, plant and equipment, but also the accounting policies. So you must also state those accounting policies. I see in the solution they didn't include them. I included them for your learning purposes, right? But in the exam, if you get a question like this, also disclose the notes, right? Because disclose the notes, but also the accounting policies, because they form part of the notes. Deferred tax, they also want you to disclose the deferred tax. For the deferred tax, you must also disclose the accounting policy for deferred tax. in addition to the calculation you're gonna disclose. So what I want you guys to do is to keep this example, because I'm gonna take it out here. I'm gonna go through my examples that I've prepared. Yeah, so this is how I'm going to answer the question, right? I'm gonna answer the question like this. I'm gonna say no disclosure. And remember, just to give you a TSM technique, ne? When you get a question like this, you go and do a structure first, right? Of what you're going to disclose. So you're gonna have a no disclosure, you're gonna have accounting policy, property, plant, and equipment, right? I'm gonna take you through what I'm going to disclose. You don't have to write everything that I've written here, but I've just highlighted keywords that you need to disclose under the accounting policy. Number one, what you need to disclose is that items of property, plant, and equipment are measured at cost less accumulated depreciation and any accumulated losses. Is what we have discussed, me and Solomon, last week. You will see it's there in that lecture. So this is what you're going to disclose so that the users can see, right? And then also what you're going to disclose, you're going to disclose that cost includes, you're going to disclose the cost, right? You're going to state, to tell the users that the cost of property, plant, and equipment include costs incurred initially to acquire or construct an item of property, plant, and equipment, and costs incurred subsequently to add to or replace part of or service it, or if a replacement cost is not recognized in the carrying amount of an item of property, plant, the carrying amount of the replaced part is derecognized. So what I want you to see is for you to disclose the cost. Number one, you disclose how the property, plant, and equipment is measured. Right? How is measured? You take the cost minus the less accumulated depreciation, take the cost minus. So what the lecturer wants to see, he wants to see how the item of property, plant, and equipment is measured. You state the item of property, plant, and equipment is measured at cost less accumulated depreciation and accumulated impairment, and is there under IS 16. You'll see. What else that will want you, your lecturer will want you to disclose, right? Under the accounting policies, right? The lecturer will want you to disclose under the accounting policy the cost. You state what is the cost. And remember, guys, you don't have to stress about this. All you have to do is just you write your notes down to say under accounting policies, I'm going to disclose how the item of property, plant, and equipment is measured. You just write your own English. You don't have to worry as long as these keywords are there, right? Then also cost, you disclose the cost incurred. Include cost incurred initially to acquire or construct an item of property, plant, and equipment, and costs incurred subsequently to add, replace, or whatever. I've read this already. And then also what else that you need to disclose under accounting policy? You must disclose the residual value, depreciation method, and useful life of each asset are reviewed at each annual reporting period if they are indicators. So the key word here, you must say, I'm going to disclose under accounting policy residual value, depreciation method, and useful life. And I'm going to state that these are reviewed every year. That's it. You don't have to confuse yourself. So these are keywords that you need to write down to disclose under accounting policies, right? So, and then you state that these are estimates, so they should be, how are they, these are the change in estimate if they change, right? Then what else that you need to disclose in terms of the keywords? Depreciation is charged so to allocate the cost of an asset less their residual value over the estimated useful life using the straight line method. The lecturer will also want to see the straight line method. The following rates are used for the depreciation of property, plant, and equipment. So I took the one from the question. In this case, how did I get the 4%? The 4% is the 25 years. So 100 divided by 25, the building, right? The 25 years is what is on the question there. So I took the 100 divided by, I converted it into percentage. So I have 4%. Then for machinery, 20%. What I did, I took 5 years. I took 100 divided by 5 years. I got 20. So that's the percentage, right? And then you also disclose the impairment of non-current assets, whatever, and that's it. So under accounting policies, have these words there. You'll get your marks, right? Let's move on. Under deferred tax, income taxes, you must also disclose the accounting policy for that. You'll state the following. Under deferred tax, what your lecturer will want to see is the following. The tax expense for the year comprises current and deferred tax. So what your lecturer will want to see is what constitutes the tax expense. You must state that it includes current and deferred tax. Tax is recognized in profit and loss. You want to see that, right? Except that they change attributable to. You don't have to just these keywords are very important, guys. I just want to highlight these keywords for you. So deferred tax is recognized on differences between the carrying amount of an asset and the liabilities in the financial statement, and their corresponding taxes known as the temporal differences. So you want to see those words. The net carrying amount of the deferred tax assets is reviewed at each reporting date and is adjusted to reflect the current carrying amount, right? So when will it be adjusted? When maybe, for example, there's a change in rates and whatsoever, right? So these are the things that your lecturer will want to see. So write these keywords down because they will be very important. If you are asked in the exam to also disclose the accounting policies, this is what you're going to disclose, right? Now let's move on to the example now. You remember we bought the land at the 1st of March, né? So let's go back there. 1st of March 2015, right? So that's when we bought the land, and then also we bought the building on the same date, 1.8 million. And then the machinery, we bought it on the 1st of September. So when I calculate my depreciation here, I have a formula. You know what? This thing. Okay, I'll come back and present this presentation. Eh? I think the original, because I initially did this thing in my example for PPE. Let me just quickly check it. If the formulas are still showing there. Yeah, there. I remember, oh, here I was just showing you the disclosure. It's fine. Let me first take you to the calculation. Eh? Let me just take out this example. We'll come back to it so that when we show the presentation. So can you see this from your side, guys? Can you see it from your side?
Mm-hmm.
Just bear with me, guys. I know I'm taking a lot of time, but it's worth it. I'm taking a lot of time, but it's worth it. So that when you go and prepare, you know exactly what's happening. Let's go back. So now we bought our year end is 30 June. Purchase date for these two items, 1st of March. So we bought the land, the building. The total cost was 3.2 million. Right? The property was available on the 1st of March whatsoever. And then we had the residual value. And then we also had the 25 years, which is that 4%. And then we also had the fair value, which is 1.5 million. Tax base I've calculated for you. The tax base for the land is 1.4, for the building is 1.8, right? And then the SARS allowance gives you 5% for the building, but for the land, remember you don't depreciate. Right? Now let's go first to this. We'll go back to the machinery. So what I want to show you, what I did, my calculation. I took the cost for the land. We have 1.4 million initially when we bought an asset. So at year end, meaning 2016, because we bought it in March, remember? This is in March. So now if we move from, our year end is June. So if we move from March, April, May, June, which is 4 months. So now we're gonna end up in June 2016, which is the year end. So now we are here. For the land, we are not doing anything because the fair value we were given 2017. So for the building now, we have 1.8 million. So if we move it by 4 months, how much you're gonna have? What I did, I took the cost minus the residual value, right? So B7 is the cost. Let's go to B7. You'll see is the cost. Yes, B7. The residual value is B13. So I did that, and then I minus that, and then I divided it by 25 years. Then I divided it by 12 to get how much per month is, right? So remember, we bought it in 2015, guys. So I counted 4 years. I made a mistake. So we are 30 June 2015. That will be 4 months, right? So now when you come from 1st of July 2015 to 2016, it's another 12 months. So when you take the 12 plus 4, that's 16 months, right? So this is where the 16 is coming from. You see? So I get to the depreciation of how much. Basically, this is an accumulated depreciation. This is how much am I gonna get. So in your solution, you see, you'll have that. So the carrying amount as at 1st of July 2016 for the land is 1.4, for the building is 17, right? And then do we have Okay, we're still gonna come to the deferred tax. So that's how much we have in total. So if you're wondering where's the 600 coming from, this is how they calculated it. So now let's move on now to 2017. If you look at your question, you had a fair value adjustment of 1.5 million for the land, but you also need to depreciate now the building. So for the land, we're gonna fair value revaluate it to 100,000 to go to 1.5 million. The building, you need to depreciate it obviously by a year, which will give you 49,200. So that 49,200 in your solution, that's where it's coming from, right? So now at year end, your current value of the building is 16,85200, right? And then let's go to the machinery now. The machinery, we bought it on the 1st of September. But remember, I said to you guys, this was not the available for use date. The available for use date was 30th of September, right? And then we bought it for 1.6 million. And then we had the cost, pre-production, whatever, of 35. And then the revenue from sale of samples, 1.4. So what is your cost for this building? The cost for this building is 1692. So in your solution, the cost for 1692 for the building, this is how they calculated it. They took out the revenue samples from the sales, right? And then this is how they got to the cost. And this cost is going to be the same with the one for the tax. They're going to be the same, right? So they're available for use the 1st of October. So when you calculate depreciation, we must start counting from the 1st of October up until year end. Similarly here, with for tax, same thing. The useful life is 5 years for the building. So that's 20%, right? The cost, this is the tax base now. So now if you had to sell this building now for a certain amount, the tax base will be this amount, which is going to be the same. The tax is 28%. So now, when we come here, so in this case, it's additions because we bought it during the year, 30th of September or 1st of September. So now the depreciation is going to be for 9 months, because if you count from available for use date from October, November, December, January, February, March, April, May, June, year end, 9 months. So we're going to calculate depreciation for 9 months, right? Divide by 5, divide by 12 is how much the depreciation per month, multiply by 9. Here's the depreciation. If you look at your solution, you'll get the same thing, right? So now that we have calculated the carrying amount and we know the tax base, now let's look at how the deferred tax we're going to calculate, right? So your cost is this much, 1.8 million. This is what? The building, right? So we're calculating the deferred tax for the building. So initially when you buy an asset, the cost and the tax base will be the same, right? The temporary differences will be the same. I wish I can take you through the definition of a tax base, guys, but due to time, go through my previous week's lecture. That's where I'm explaining everything. What is the tax base of an asset? What is the tax base of a liability, for you to get an understanding. If you're still not sure, next week I'm still available. Ask me questions. I'll always respond to your questions, right? So initially when we bought this building, we're not going to have deferred tax consequences. But the deferred tax consequences are caused by the difference in our depreciation. Because initially, our depreciation that we've calculated above is so much. And then for the tax, remember, we're going to apply for tax purposes, because it's a building, they are giving us 5%, right? This is 5%. And then from our side, we're depreciating it for 25 years, if I remember. So for tax purposes, it's 5%. So here's the 5% there, right? So at the end, we're going to have to calculate deferred tax. So this is where their deferred tax is coming from. They multiply it by 28%. So the temporary differences is 114. So just to simplify this thing, guys, it's basically this. If you go through my lecture, if I had to apply this in a vertical format, I want to simplify deferred tax for you. I don't want to complicate it, right? So what does this mean? It means this, right? It's this. I'll explain you. Deferred tax, guys, is not complicated, right? So you have a tax. What does this mean? Remember what I said to you. I said the carrying amount of an asset represents the equivalent revenue you're going to generate. So what you are basically saying to the users is the following. Saying to the users of the financial statements, I have this asset, which is a building. Of this asset that I have, which is a building, for future reference, right? Meaning that from 1st of July up until the end of its useful life, I'm going to generate revenue of 1.7 million. But having generated that revenue for 1.7 million, SARS is going to give me deductions of 162, which is that. Because remember, this deduction, you're still going to get it as you use the asset. So meaning that users of the financial statements, having done that, if SARS is giving me deduction of 1.6 million, I'm going to pay tax of this revenue that I'm going to generate of based on 114. And what is that tax, which is the deferred tax? Remember, guys, the deferred tax is the future tax. So how much am I going to pay? I'm going to pay tax to SARS using this machine, generating revenue of 1.7 million, getting deductions of 1.6 million. I'm going to pay tax of 32, right? So now I must record this tax in my books. How am I recording the tax in my books? I'm going to recognize the taxation expense, the journals you're going to pass. And I'm also going to recognize the deferred tax liability. Right? The journal I'm going to pass in my books. I don't have time today. I was going to also take you through the auditing part, but maybe next week we'll see. We're just limited in terms of time. So these are the journals we're going to pass, you see, to recognize that deferred tax. You guys understand this example that I've just done for you? Because this simplifies it for you in as far as the deferred tax is concerned. I don't want you to confuse with deferred tax. Deferred tax is very, very simple, right? So this is where we are now. So you continue doing that for the following year now, which is our financial year at year end June. So the same thing here, you do the same. Here's the revenue, here's your deduction, here's your income. This is how much you're going to pay as a tax, right? So your tax you're going to recognize is the movement, is the difference between that and that you're going to pass it a journal. So now that you've done for the building, the land one is simple. The land one, we have a land that we are keeping it for capital appreciation, but now we fair value it every year. Similarly here, in fact, here also I've made an example for you. I'm saying to you, here what I'm doing, I'm basically calculating. Let me change this also to suit the example, because I don't want you to get confused. So what I have here is the deductions in the form of tax fees. Right? I'm telling the users that this is it for capital appreciation, meaning that in the future period, I can sell it. I cannot use it. You can't use the land, because when you start using an item of PPE, you must depreciate it. So you can't use the land. The only way you can get some future economic benefits is by selling the land. So you are telling the users that in the future period, if I decide to sell this land, I'm going to sell it for 1.5 million, right? But now, SARS is going to give me deduction in the form of a tax base. Okay? Tax base of 1.4 million, right? Of that 1.4 million, the difference of this will be a capital gain. And this capital gain, users, SARS will tax me on 80% of it, right? And if SARS is taxing me on 80%, it means the tax I'm going to pay on the 80% is 28%. This is how we got to the 22,400. You understand?
Yes.
Yes, thank you for the feedback. I'm expecting you to give me a feedback. Guys, please, it's very important. Ne? This is very important, because a lot of people are getting it wrong. For land, when you calculate consequences, you calculate as recovering the land through sale, not through use. And what I've just done here, I was just verifying it for you in the future reference say that when you decide to sell the land, these will be the consequences. You're gonna sell it at 1.5 million, and then SARS is gonna give you a deduction of a tax base of 1.4 million. Then you're gonna generate a capital gain of 100,000. Of that capital gain, you're gonna generate, you're gonna include it the capital gain of 80,000. Then of the 80,000, SARS is going to tax you at 28%. And you had that effective tax rate of how much? Of 22%. It's coming from here. That is 80% multiplied by 22%. Happiness. I'm moving on. Machinery. Similarly with machinery, we bought it editions on the 1st of, I can't remember the date, on the 1st of September. We bought it so much, and then we provided the depreciation size is giving us a 40%, right? Remember, based on the question that we have read, initially we got 40% and we don't apportion, but for the depreciation we did apportion. So similarly here, we have revenue of 1.4 million. Guys, there's some noise that is coming through there, and I think it's disturbing everyone. If you can just mute. So I'm not quite sure with it. Just mute. Solomon, you can still hear me though, ne? Rita, you can still hear me, ne?
Yes, absolutely, yes.
Yeah, yeah. So I'm saying for machinery, you have 1.4 million carrying amount, which is equivalent to revenue, minus the deduction you're gonna get from SARS of 101, and then versus how much your taxable income of 43, which is temporary difference. Then this is how much tax you're gonna pay on that taxable income, which is deferred tax. The reason why it's deferred tax because it's a future tax that you're going to pay from using this machine, right? Happiness. So I'm taking out this example, and then we are going through the presentation that I did so that you can see where the figures are coming from. Right, now we need to present this in the financial statement in terms of the disclosure note. So now we're here. I've taken you through the accounting policies. Guys, please advise if you can see my example. Can you see them? Can you see?
Yes.
All right. So I've taken you through the accounting policies. Now I'm disclosing the information, right? So this is how you're going to disclose it. And if you can, just turn the skeleton so that in the exam you present it like this. It will be very much quicker for you because once you do the skeleton, then what you do, you go and do the calculation. Then once you're done with the calculation, you come and fit in the amount. Then you are done. You see? So here's the skeleton. Number one, no disclosure to the financial statements. Under property, plant, and equipment, we have three things. We have land, we have building, and then we have machinery. That's the description. The cost is this cost. You're familiar with them from the scenario, right? And you have accumulated depreciation. We've calculated it. You can always refer to the scenario. Then you have the carrying amount. When is this? This is the current period, right? So your carrying amount for land, we fair value it. It's 1.5 million. And then for building, it's 16 million, the carrying amount after depreciation. For machinery is 14. It's 1.4 million. Now you must also come here and do the record. The carrying amounts of property, plant, and equipment can be reconciled as follows, right? The land, you have land, 1.4 million initially, which was the carrying value at the beginning of the year. Now you fair value it in the current period. Now you have a carrying amount, carrying value at year end of 1.4 million. Then what else that you have? The building 1734, and then you had a depreciation of this much for the current period, right? The reason why, okay, the PPE, it was an addition. That's why you don't have a carrying amount because we bought it in the current period. So you must come and present it as such, as addition. You must show it as an addition. Then you have a revaluation, which you don't have for building. Disposals, they were not disposals. Depreciation, and then you have a carrying amount. Ne? Then you go and present also the 30 June 2016, which is the prior period. So prior period, because we didn't have a machinery in the prior period, we only had this. The land was still 1.4, the building 1.4 cost minus the depreciation, right? But the recon for it came like due to the following. It came as a result of the land. The land, there was no movement, still the same. There was no additions, there was no revaluation, there was no disposals, there was no depreciation. So it's still the same. For building, you bought it for so much, right? And then you had a depreciation, and then there we go. We had a cost, right? Had a carrying amount, right? And then the reason why we have this amount here, because remember the building, we bought it in 2015. So there was a depreciation element here that I calculated there. Here's a formula for 4 months beginning. So for the current period, 2016, it will be that much for 12 months. Then you have a carrying amount. Then for PPE, guys, this will help you a lot. I don't know, you just need to take this structure or go through this lecture note, take this structure, present it in the exam. First, do the skeleton. Do it like this. Have a property, plant and equipment, description, cost, accumulated depreciation, carrying amount. Do the recon at the below. Then do it also for the prior period like this. And then also have a recon like this. Then go do your calculations the way I've presented them. Then come and fit the amounts in the skeleton. Then I'm telling you, you can do this question actually within 30 minutes, you're done. You see, this is how you should do it in the exam. So first I would say to you, I'll push you to say, know this structure. In fact, cram it. That's what I can say. Know the structure very well, so that when you are in the exam position, you are asked to present the notes in the PPE. You present them like this. Then you come and feed in the amount based on your calculations. Then within 30 minutes, you'll be done with this question. So now let's go to the deferred tax now. How do we present the deferred tax? Deferred tax 2017, I'm showing the comparatives. I'm showing 2017, I'm showing 2016, right? So based on the calculations that we have done there, go through the lecture where show where these amounts are coming from. You'll see they are there in the solution. So now the total amount for deferred tax is that amount, but how did it came about? It came about due to the following. Land for the current period is so much. You'll see on the solutions there. And then for the building, and then for the machinery, here's the total. Then you come and present it as a temporary differences there, right? Because it says here the deferred tax balance beginning of the year, movements consisting of the temporary differences of so much, right? Did you have any change in rate? No, we didn't. If we had, we're going to also present here for change in rate. Increase or decrease in tax losses available for set off against future taxable income. In this case, I'm talking about the assessed losses. There was none. So I've just added these notes for you guys for learning purposes, but should it happen in the exam, you have this is how you need to present it. So you have comparatives, you present the prior, you present the current period. The deferred tax liability arises from the following temporary differences. System. They are coming from our calculation. It's unfortunate I can't put both screen here, but you'll see that 22 when you look at the solution, it resulted from the land, then it resulted from the building, then it resulted from the machinery. The total amount is that which is presented there on top, right? And then the deferred tax liability is this much. The deferred tax asset we didn't have. In this case, we had the liability. We would have had a deferred tax asset if we had calculated the deferred tax on a liability or asset loss. So in this case, we didn't have. That's it, guys. You're basically getting all these marks. You see, if you present it like this is how the notes should be presented. You get all those marks that you're supposed to get, right? So that is me. Unless there's any other questions, I think we're done with the lecture. Any questions from your side?